Subscribe our channel eFinance Management and click on the bell icon to get update on new videos. Today we are going to study methods for estimating working capital finance. There are broadly three methods of estimating or analyzing the requirement of working capital of a company, viz. Percentage of revenue or sales, regression analysis method, and operating cycle method. Percentage of sales method. It is the easiest of the methods for calculating the working capital requirement of a company. This method is based on the principle of history repeats itself. For estimating, a relationship of sales and working capital is worked out for say last 5 years. If it is constantly coming near say 40%, that is working capital level is 40% of sales, the next year estimation is done based on this estimate. If the expected sales are $500 million, $200 million would be required as working capital. The advantage of this method is that it is very simple to understand and calculate also. Disadvantage includes its assumption, which is difficult to be true for many organizations. So, where there is no linear relationship between the revenue and working capital, this method is not useful. In new startup projects also, this method is not applicable because there is no past. This method expresses the relationship between revenue and working capital in the form of an equation: working capital equals intercept plus slope, multiply by revenue. The slope is the rate of change of working capital with 1 unit change in revenue. Intercept is the point where regression line and working capital axis meets. At the end of the statistical exercise with past revenue and working capital data, we will get an equation like below: working capital equals minus 6.34 plus 0.46, multiply by revenue. To calculate working capital, just put the targeted revenue figure in the above equation, say $200 million. Working capital equals minus 6.34 plus 0.46 into 200 equals minus 6.34 plus 92 equals 85.66 or $86 million. Therefore, we need $86 million of working capital to achieve revenue of $200 million. Operating cycle method. This is probably the best of the methods because it takes into account the actual business or industry situation into consideration while giving an estimate of working capital. A general rule can be stated in this method. Longer the working capital operating cycle, higher would be the requirement of working capital and vice versa. We would agree to the point also. The following formula can be used to estimate or calculate the working capital. Working capital equals cost of goods sold, estimated, into number of days of operating cycle divided by 365 days, plus bank and cash balance. If the cost of goods sold, estimated, is $35 million and operating cycle is 75 days and bank balance required is $1.25 million. Therefore, working capital equals 35 into 75 divided by 365 plus 1.25 equals $8.44 million. In this method, each component can also be calculated. It means bifurcation of $8.44 million can be done in inventory, cash, accounts receivable, accounts payable, etc. Thank you. Please subscribe, like, and share our video.